Hello and welcome to the BDO Talking Trust 2021 series. This is the final episode of our four-part series, which aims to bring clarity to the purpose and application of trusts in wealth management. In this series, we host experts in tax structuring, trust law, and family business governance in an aim to bring clarity to the opportunities and solutions on how to get the trust working for you and your family's long-term wealth creation. I'm Ricardo Teixeira, Chief Operating Officer at BDO Wealth Advisors, and I'm your host for the Talking Trust series. Thank you for joining the conversation. Today's webinar will be recorded and added to our website and BDO YouTube channel, together with all previous episodes in the series. We have set aside time for an interactive Q&A session following the talk. So if you have any questions or areas that you'd like to have discussed further, please line them up by using the Q&A function. We will also be sharing a link to a useful checklist in the chat function at the end of the talk. You will find the chat function in the top right-hand corner of your screen. So look for the speech boxes with a question mark. BDO has been providing professional audit, advisory and tax services to families and businesses for over 60 years in South Africa. And to be candid, we've seen a lot of trustees and families struggle with optimizing the family trust for wealth creation. Trusts are, however, wonderful vehicles. By having the right solutions and processes in place, the trust can be extremely beneficial to a family's wealth creation and protection. The trust is a unique structure, though, and certainly more complicated than managing a company. There are many nuances to maintaining the validity of a trust, and as a result, any shortcoming in managing the trust, no matter how insignificant it may appear at face value, may have a devastating consequence on the original purpose and intent in establishing the trust. Our objective in hosting the Talking Trust series is to share practical knowledge and experience of the best practices for effective governance and administration of a trust. So trust accounting is not trust administration. A valid and correctly administered trust is so much more than compiling annual financial statements. There are many misconceptions and much misinformation about trusts and trustees' responsibility for administration. Pierre van der Spey, who you met on episode 2 and 3, is back to close our series. Thea and I will unpack the myths and realities of trust administration. I will discuss what is required to ensure that the trust is not at risk of being seen as an alter ego or sham trust. I'll deal with the best practice for trust administration. I'll draw on our practical experience at BDO from working with trustees, and Thea will amplify the best practice with examples of case law and real-life situations that she's encountered in advising trustees when things fall flat. So let's get started and explore why trust accounting is not trust administration. The most common misunderstanding and misconception about trust administration is the accountant's version. I can say that as an accountant myself, but a balance sheet and an income statement is just that. It's a balance sheet and income statement. These two reports are elements of what is practically referred to as annual financial statements. Annual financial statements are great accounting reports that show the financial position and financial results for a trust. But they're just that, annual financial statements. They do not meet the benchmark of regulatory requirement for trust administration. And in fact, financial statements are not even a requirement in terms of the Trust Property Control Act. And certainly do not, on their own, serve as evidence that a trust has complied with the requirements of the Act. What is required for trust administration is that trustees actively manage the trust, assets, and document decisions for each transaction. And this entails the recording of decisions in minutes and resolutions, and maintaining an audit trail that ultimately substantiates the actions that have been taken by trustees. So regardless of where the financial statements are prepared, if you don't have resolutions, if you don't have minutes of meetings or supporting documents, you're basically giving SARS or creditors, which could include soon-to-be ex-spouse, grounds to prove an alter ego. And that ultimately results in a complete disregard of the trust with rather negative consequences. So often financial statements are first prepared and then resolutions drafted to support the financial statements. We call this reverse engineering of trust accounting, and it's a very dangerous approach to follow. This practice is flawed, and we've seen numerous scenarios unfold where trustees are challenged because of the backdating of resolutions or the ratification of transactions after the event. So where does this misguided practice of trust administration emanate from? The issue is one of lack of knowledge. At the heart of poor trust administration is not knowing what you don't know. The default position in administering a trust is to start with what we know, and that's a company. But a company is not but a trust is not a company. And so let's just pause and reflect on the attributes of a company and focus on the language that describes a company. Company, it's one of the most commercial legal entities known in South Africa. The administration of companies is well documented in the Companies Act, as well as by the CIPC regulations. And CIPC stands for the Companies and Intellectual Property Commission. So a company exists as a legal entity. In law, a company is considered as having a soul, which really implies that it has an identity. And as a result, a company can sue and be sued. But yet a company stands independent of its shareholders. So it has its own identity. It is owned by shareholders, but a company is under the management and control of its directors. The levels of authority in a company are clearly defined by the company's memorandum of incorporation, which is read with the Companies Act. And as a result of these defined levels of authority that are delegated to the board of directors and public officers of the company, all decisions are made by the directors. Certain company decisions are voted on by directors and others are voted on by shareholders. The common principle in managing a company and implementing decisions in a company is to apply the rule of majority vote. Right, so let's now compare the company attributes with that of a trust. Each trust is bespoke and comes into existence through the reference by its trust deed. The trust deed is a contractual arrangement giving instructions to trustees. The Trust Property Control Act forms the framework in which trusts operate, and it essentially sets out the high-level requirements and fiduciary obligations of trustees in relation to the administration of the trust. But all decisions and actions taken by the trustees must be made with reference to the trust deed and not the Trust Property Control Act. So the trust is registered with the Master of the High Court, and as a result, trustees are accountable to the Master in all regards for the administration of the trust. The Master of the High Court therefore has ultimate authority over a trust and hence is seen as the ultimate regulator for trusts. As the trust is a contractual arrangement, it's not a legal entity. A trust is essentially an accumulation of assets which have been held for the benefit of beneficiaries. And so it's not a juristic or legal person. But there are instances in certain statutes, like for example, the Income Tax Act, where the trust is regarded as having a separate legal identity. So by not being a legal entity per se, without that legal personality, a trust doesn't have legal standing and therefore itself as a trust cannot sue or be sued. The trustees act on behalf of the trust and in this capacity can bring and defend actions concerning the trust. Trustees are under a fiduciary responsibility to administer the trust assets. Trustees are representative owners of trust assets, and trust assets need to be registered in the name of the trust. And all of that, and all these assets remain under the direct control of all trustees. And lastly, every action and decision is taken for the benefit of beneficiaries, as instructed by the trust deed. So beneficiaries that are either identified or identifiable in terms of the trust deed could benefit, and beneficiaries could be individuals or legal entities. And lastly, trustees apply the joint action rule in making decisions. There are no levels of authority in trusts. Let me repeat that. There are no levels of authority in trusts. There's no CEO, there's no MD, there's no main trustee. All trustees are required to agree to actions taken by and behalf of the trust. Trust actions are to be done and agreed to collectively by trustees. So it's very common practice to refer to a trust as being run by resolution, where trustees sign and agree to resolutions. There's no majority, and there's no casting vote. So with those two comparisons, I think it's quite evident that the company and the trust are unique structures and have very little in common. So what is good administration for a company will not be effective for a trust. The Trust Property Control Act gives context and reference for trust administration. The Act in itself is a very brief 10-page document. It's light on detail, only a very high-level framework as guidance for trustees in fulfilling their duties. The essence of trust administration is largely encapsulated in paragraph 16 of the Trust Property Control Act. And this section is titled, "The Master may call upon trustee to account." So if you allow me to read from the Act, just verbatim, it says, "A trustee shall, at the written request of the master, account to the master to his satisfaction and in accordance with the master's requirements for his administration and disposal of trust property, and shall, at the written request of the master, deliver to the master any book, record, account, or document relating to his administration or disposal of the trust property, and shall, to the best of his ability, answer honestly and truthfully any question put to him by the master in connection with administration and disposal of trust property." So the crux of trust administration is therefore centered around accountability. It's accountability of trustees to the master, accountability of trustees to beneficiaries of the trust. And what is clear, what is clear from the Trust Property Control Act is that once a trust is registered with the Master of the High Court, the trustee's obligations for trust administration begins. So regardless of whether the trust has assets or not, regardless of whether the trust is dormant or active, all trusts, registered trusts, need to be actively administered. And it's simply not true that a dormant trust is exempt from administration. They all need to be administered. Now, since the Trust Property Control Act is so thin on detail, the courts have, through case law, demonstrated that trust administration will be viewed by a couple of pointers, and essentially viewed by ensuring compliance with the provisions of the trust deed, ensuring compliance with all statutory requirements of the Trust Property Control Act, and conducting of proper trustee meetings, recording of those meetings with minutes, recording of decisions by the trustees, and ultimately a catch-all proper maintenance and safekeeping of trust documents and assets. So there's a lot of administration at first reading of the Act, and it may seem very overwhelming for any trustee. And so what we've done as BDOs, we've developed a framework to guide trustees. And this framework we have taken from SARS as an acronym. And as you know, SARS stands for the South African Revenue Services, which is really our tax man in South Africa. But since there's such a tax focus on trusts, we thought that SARS would be would make for a memorable acronym for trust administration. And what it stands for is essentially set up, act, record, and statements, SARS. And the SARS is essentially a cycle of administration. It starts with the trust deed. So setup is basically setting the foundation, and the trust deed sets a contractual obligation for the trustees. Trustees then need to take action, and the action is to be actively involved and actively manage the trust assets and actively take decisions for the benefit of beneficiaries. Once those actions and decisions have been implemented or been taken place, you then need to record and document those decisions. Documents, documents, documents is the BDO mantra of good administration. And the cycle ends with prepare and report statements. Statements for beneficiaries on distributions and access to records, statements for the master in terms of accounting for transactions and assets, and statements to SARS for tax compliance, showing connected parties and the financial transactions of the trust. So using SARS as our framework, set up, act, record, and statements, let's unpack each step in the cycle and explore what's best practice and talk about some of the consequences of not getting it right. So Effective trust administration starts with understanding the trust deed. Each trust deed is unique, it's bespoke, and it's a bespoke document, and therefore to set up your administration, the starting point is the trust deed, and the need is to then look at the deed and make sure that you've catered for the specific requirements of that deed. The deed will really, at a high level, specify what trustees can do, or to specify their powers and obligations. And those powers and obligations could extend to managing assets, borrowing money, lending money, making donations, and even amending the trust deed. And essentially the deed as that foundation is really where all the instructions are embedded for trustees. Key requirement in terms of setup is opening a bank account. Critical step in the setup phase. Every trust must have a bank account. In addition, the founding donation needs to be deposited into the trust bank account. Without this basic step, the trust does not come into existence. A letter of authority essentially confirms the trustees to the trust. And as we know, and we've mentioned before, is that trustees are the representatives of trusts. And so there is a need to have trustees confirmed by the Master of the High Court before acting, and that's contained in the letters of authority. And lastly, the asset register is critical to identify trust property. The asset register is a record of assets of the trust. It's not an accounting statement, but it's a detailed record of the trust assets, and it shows a description of each asset, how it was acquired, and how it was funded. You know, the assets can be transferred to a trust by sale, or by a donation, or by inheritance. And regardless of how assets are transferred, it's documenting that in the asset register, whether it's with a loan agreement, donation, or a will. And so this summarizes the best practice for the setup phase of a trust admin cycle. I'd like to ask Fia and bring her into the conversation now and ask her to consider some of the practical examples of where this can go wrong and the consequences. Fia?
Good morning, everyone. In practice, we see that majority of our clients underestimate this pillar that Ricardo calls a setup phase, because a lot of people get off-the-shelf vanilla type trust deed, and they never apply their mind in terms of how to tailor this trust deed to actually meet the needs of their family or the purpose that it's been set up for. So when you look at the trust deed, you actually have to focus on two very important issues in the trust deed, is around the powers. Which powers are you giving to the trustees? In other words, what are they allowed to do? Because if you don't give them a power in the trust deed, you cannot use, enter into any transaction in the trust if it falls outside of the powers provided in the trust deed. A Evenhanded case in 2003, the court specifically said that you cannot expose a trust to business risk unless the trust deed so allows. So I was just thinking in terms of our family governance conversations, if we want to allow the family, especially later generations, to participate and maybe start their own businesses, you have to actually allow for those powers specifically in the trust deed. And in the Evenhanded case, where things went really wrong, is the trustees relied on the power, which was very wide, to say they allowed to manage the affairs of the trust. So under that, they read in that they could actually, for one of the beneficiaries, enter into a suretyship. And as you can expect, obviously things went wrong, and the funder called on the surety. And basically, the court said, go back to what was the purpose of you setting up this trust. When they read the trust deed, it said the purpose of that trust was to actually benefit all beneficiaries, and it has to be distributed, amongst all the beneficiaries upon the termination of the trust. And also, the trustees have to protect the assets. So you could see, even though they use their wide powers, they actually gone against the actual purpose of the trust. So one must be very mindful when you set up the trust deed to focus on the powers, and the powers must be in alignment with the purpose that you set up this trust. When we look at the purpose, there's also obligations in the trust deed. When there's obligations, it means the trustees have to do certain things. In a case in 2021, Malachi versus the Dwaba case, the courts actually undone a trustee appointment and said the trustees haven't followed due process. So if the trust deed forces you to follow a specific process or do specific things or things in a certain way, you have to make sure you adhere to the obligations. Now, most trustees we deal with have never even read the trust deed. So it is so important that you understand when you actually act as a trustee, that you understand which powers you are given by the founder, as well as the obligations that go along with it. As a quick example, testamentary trust has been set up. The daughter and her brother were relatively young. And when the mother died of cancer, she and the father got divorced many years ago. The father came back on the scene and he was trying to reunite the family. And he was appointed as a sole executor, sole trustee. What happens, he abused his powers completely. He was supposed to take a tiny trustee fee. That was all he could take. He had considerable obligations in terms of the will, that he had to look after the children. He abused those powers completely, and the obligations, could either be in terms of the trust deed, but there are certain legislation that also have obligations, such as you have to open a bank account, as Ricardo said, you have to submit tax returns. So it's very important that you consider all of those. So we're busy in the process to have that trustee removed, just because he was acting completely outside of the powers, completely outside of the, not considering his obligations. And he basically just did whatever he wished and took money for himself, which he was not allowed to do. So very important to understand what powers you're given in the trust deed. So when we look at the bank account, Section 10 says you will have a bank account, whether your excuse is that not enough money is flowing. As Ricardo said, many people call it a dormant trust. The moment your trust is registered, you have to open a bank account in terms of Section 10. So we dealt with the F&B case last year. So maybe for those who didn't listen, worthwhile to actually go and have a look at. The court really slammed them because they haven't paid the rentals that they received, from themselves basically into a bank account. So it is all about demonstrating that we recognize the existence of the trust, even though we are related parties. It's very important to keep the trust as a separate entity. And Section 10 of the Trust Public Control Act says you cannot receive money and keep it in your hand. You have to deposit in a trust bank account. So you cannot mingle funds, and there's absolutely no discretion. You have to do that. Whether the founding donation has to be paid, yes or no. There's a court case in 2017 where the courts actually said that it's not an essential factor for a trust to exist, which I don't agree with. So what the court said, as long as the trustees have, in terms of the trust deed, a right to demand, and the founder has got an obligation to pay, it is not an essential factor that that physical tiny 100 Rand has to be physically paid across. My issue is, if there's just this remaining obligation and something happens to the founder now, at what point do you have a cutoff to say, right, we still have this obligation, but now this founder passed away? So I think it's just really good governance, and it demonstrates that we recognize the trust as a separate entity. And the moment we receive that 100 Rand, as Section 10 says, you can't keep it in your personal hands. It has to go into the trust bank account. So little things, the courts look at where it may just add up to, the trust not being recognized, or having some dire consequences. In terms of a letter of authority, we see a lot of people in practice not getting that right. No trustee is allowed to act as a trustee before his name appears on a letter of authority. That is where the master has authorized you to act. So without that, if you've been nominated by trustees in a resolution and the trust deed or the resolution says with immediate effect, it does not override, the notion that you actually have to be physically authorized by the master in terms of the letters of authority. So very important to always make sure that people who sign resolutions are people who are already appearing on the letters of authority. Asset register, that is the requirement in terms of Section 11 of the Trust Property Control Act to have an asset register for trust. That's actually the only requirement in terms of the Trust Property Control Act, and that comes close to accounting. And the purpose is really the master and the courts want to know which assets belong to the trust, where are they, how they were acquired, do we have a full list of the assets that the trustees are actually taking care of. So, once we've got the trust properly set up and it's tailored to our family's needs, then obviously trustees have to start acting, and that's the next pillar Ricardo would have a look at.
Thank you, Fia. So moving on to act. Trustees need to collectively and actively manage the trust assets. And this requirement of action is to be done in the best interest of beneficiaries. We often come across this scenario of puppet trustees. It's a no-go. Beware of the dominant trustee syndrome. All trustees need to be active and actively involved in the management of the trust. And that's actually at the heart of trust administration. And how you demonstrate that as trustees, this action of acting, is through meetings and actively engaging on decisions. Trustees need to take control of assets, and the way to do that is to demonstrate it by applying your mind. And as Fia said, the authority to act is critical. And so it's one thing to demonstrate your ability to engage and to actively involve yourself in the management of trust assets, but are you authorized to do so? A pitfall we see often is really, and building on that letter of authority that Fia spoke about, is that appointment or resignation. Appointment and resignation of a trustee is only effective once registered by the Master of the High Court. Not when you give your resignation letter or you consent to appointment, only once registered by the Master of the High Court. So if it's not documented on the letter of authority, you don't have authority to act. The joint action rule is critical in terms of the act phase of administration. And that is essentially boils down to that co-trustees must act jointly in regard to the trust administration. In our previous episode 3, Fia took us through a recent case in 2011 of Stain versus Block Pave. And in that court case, it really, I think, crystallized the fact that internally, trustees can debate. You can disagree, you can have that discussion, but externally to the world, that resolution, that signed resolution, represents the trustee's single view and decision for the trust. Only one view for the world. And lastly, meetings. A minimum requirement in terms of the Trust Property Control Act is to have one meeting per year. That's the basic minimum. However, check the trust deed that you are trustee to. Some trustees are quite specific and where they actually require a minimum of, say, 2 to 3 meetings a year, or there's specific sort of requirements around meetings. When you do facilitate engagement, conduct the meeting or convene it correctly, have an agenda, record the discussion, the audio discussion or the video discussion, capture minutes from that meeting. All of these are elements that would really demonstrate your activity of acting in the best interests of the trust and the trust assets. And so ACT is rather the crux of effective trust administration. And I know, Fia, you've got a couple of real life examples and stories I'd love you to share with us and our guests this morning.
Yes, Ricardo, as I said to you when we prepared, I mean, I could probably keep you busy for a day because I think that is where things seriously go wrong. And I think to start off with, just to give perspective as to why there are issues here, is often in family trusts, and because we're speaking about generational wealth transfer, we often in a family trust have the mother, the father, even the children, the grandparents acting as trustees. And we must understand that we are all accountable as trustees, firstly, and secondly, as Ricardo said, we all need to participate. Now that in itself is a mouthful. So why I'm saying we're all accountable, every trustee is standing in a fiduciary capacity, which means it's a legal obligation that you have to act in your best interest for the benefit of the beneficiaries. And there was a Phillips case in 2004 where the court said there's no magic in the term fiduciary duty. It simply means that you actually have, you've got the obligation to actually act in the best interest and to protect, the assets that you are looking after. In the Doyle case, one of my favorite cases. The court actually said we don't turn to the trust deed and look for fiduciary obligation there. We actually find that in the fiduciary office as a trustee. So by design, the moment you accept trusteeship, you have to act in the best interest. And I think that's very important, whether you're the mother, the father, the children, an independent trustee, we all have that fiduciary role. And then also very important is, because often in the old days, the father or the dominant person set up the trust deed, and Ricardo and I spoke, we always refer to them as the main trustee. There was a Tavistock case in 2002 where the court said they don't care if you acted bona fide, in other words, not in bad faith. If you look the other way, or if you allow maladministration, you can be removed as a trustee. That is sufficient grounds. So to blame it on you are not consulted, to blame it you don't understand anything, to blame it you're not the kind of main acting trustee. If you don't intend to actively participate, I think you should rather step off as a trustee, because the obligations that come with it far exceeds any benefit of you staying on that trust. Also, a recent case, a lot of wealth accumulated in a trust. And unfortunately, the three other siblings looked the other way, was too busy with other things. And when the father passed away at the ripe age of 93, there was 2 billion rand in the trust. And the brother, over the last 10 years since dad had a stroke, arranged the affairs, to kind of suit his needs. And the three siblings did have no clue when dad passed away what's going on in the trust. They blindly signed documents. They blindly signed not a letter of wishes, an instruction of, to actually allow the one brother to take everything upon, the father's death. So I think it's super important to actually make sure that you understand that you have to participate if you're a trustee and that you can be held accountable. Another practical aspect that we often see people are battling with and or abuse is the notion that all trustees should be treated even-handedly. That is the starting point. So no trustee can really hide behind, we have got a blanket discretion to do whatever we wish. That is not how trusts work. And it's very important, again, to go back to the purpose. As I said in the Evenhanded case, the purpose was to actually benefit all children and not one person. So in the Grissel case, it was confirmed that it is an obligation for trustees to treat beneficiaries even-handedly. And beneficiaries are actually protected against arbitrary and discriminatory treatment by trustees. So when trustees hide behind, we can do whatever we wish because we've got a discretionary power, I really think, people could actually stand up the beneficiaries and actually get them to justify, because you need a justifiable basis why you're deviating from the even-handed treatment. So obviously in the case where there's need, for example, the one child wants to go study overseas and it is allowed in terms of the definition of maintenance or welfare in the trustees. I think that's grounds, but to arbitrarily, benefit one person over others is actually not allowed. Another very practical case, which I think a lot of people can relate to, is the Vid case in 2012, where there was a rental contract involved. The father set up the trust, and they actually, let the one son get the benefit of the property in the trust and had a non-market related rental. And the courts again said, you actually have to go back to what the objective of the trust was. And the court said the powers that are given in the trust deed, enables trustees to do justice to their fiduciary duties. So it's very important, again, that you go back to the powers and the purpose. The purpose of this trust, similar to the Evenhanded one, was to actually benefit all children equally. And so it's very clear that trustees were acting out of line. Obviously, the father, was the main trustee, the dominant trustee, the mother, who was one of the trustees, was just bulldozed to sign these resolutions and to enter into this non-market related contract, and thereby prejudice the other beneficiaries. So the court said that is enough a reason to actually remove a trustee. So the courts were fed up of abuse and the fact that people just disregard trustees. So I think a lot of families in one or other way can relate to this case. So again, go back to the powers, make sure the powers, suit the family, and only do what is allowed in terms of the trust deeds, and make sure you treat beneficiaries even-handedly, and don't stretch the power. So in this case, they said, they were allowed to actually, provide rental at a non-market related rate. So then the trustees were all removed. Another very important case is one of my favorites, a slipknot case, and I think a lot of people can again relate to this, where the court said they don't allow a silent, a sleeping, an absent, or a puppet trustee. So I think you can kind of see the theme building, through where action is required. This poor guy acted as a trustee for his brother and the brother's son on the trust. He basically had nothing to do with the trust. The brother was running the trust. They ended up with him with a stack of documents to sign. He literally just signed every piece of paper, never even questioned, never asked anything. Inside that pack was a personal surety that he signed. So obviously, when things went bad, all his excuses, I'm just a farmer, it's not my assets, I'm not actively involved. The court said absolutely no excuse, no puppet trustees are allowed, no silent trustees are allowed, and he had to end up paying the funder 8 million rand out of his own pocket. So I think that demonstrates again, don't be a trustee unless you're willing to actually take the accountability and you understand that you have to actively participate in all trust decisions. So when we actually looked at the action, it's one thing to actually make sure we all act together. Ricardo referred to the Stay Invisible Block Pave case, a brilliant case where they sidelined the one daughter. Luckily, she was staying quite far and it wasn't COVID where people could use Zoom and all of those. So they arranged meetings for her to not be able to practically make it. And then they used the majority rule to make decisions. And the court said, hold on. What we actually mean with a majority decision doesn't mean majority of the trustees can be at the meeting. And so, by the way, of those people, the majority can take a decision. All trustees have to be invited to the meeting and be given an opportunity to participate. Luckily now with Zoom, it's very much easier, and it's going to be much harder to find an excuse to exclude people from meetings. In the Granzi case, the court in 2017 also got fed up, and they said, listen, trustees have to deliberate, they have to argue, they have to vote. If they don't agree, to a decision, they have to vote. You can either vote for, you can vote against, or you can abstain. But all those three are physical actions that a trustee takes. So even if you're not even invited to a meeting, which means you're not given an opportunity to participate or to give your view, then it can't be said that you could rely on majority vote. Then it's not the majority trustees who made a decision. It's actually excluding one trustee. And because we're working here with joint ownership, joint control, because a trust is so different to, for example, a company, every trustee has got a right to be heard. Every trustee's got a right to voice their views. And the court said, therefore, every trustee has to be invited to the meeting and to participate. However, in that meeting, if the majority makes a decision and the minority does not agree, the minority is obliged to actually follow and actually sign that resolution with the majority trustees. So I think that's a very nice practical case where the courts made it very clear what they mean with joint action. And the reason why we require joint action is because trustees hold assets together in equal share, for the benefit of the beneficiaries. And that's why you can be held personally liable. And that is why we have a fiduciary role that we play as a trustee. So, when we actually deliberate and we administer the trust, only way that we can prove to an outsider, such as SARS or creditors or your soon-to-be ex-spouse, is to actually report and keep documentation, which is what Ricardo is going to talk about now.
Thank you, Fia. And recording, excuse me, recording is really where administration falls flat. The obligations to act are onerous, as Fia has alluded to, with all the practical sort of case law that we've seen of late. But when it comes to recording, trustees need to keep evidence that supports the decisions and actions that you have taken. Recording and documenting the actions is the most important aspect of trust administration. And so when we talk around documents, the kind of documents we're referring to under record is really resolutions, minutes, asset register, summary of transacting entities, so who's the trust actually engaged with or transacted with, and disclosure of who the connected parties are or connected persons to those transactions. So if you go as an example, if a trust deals with a company which is owned by one of the trustees or owned by one of the beneficiaries, that needs to be reported and disclosed as a connected person. And so that in essence is really the documents. And these documents need to be kept for a minimum period of 5 years after the trust has been deregistered. That's the document retention policy. Now, this record step in the administration cycle is an onerous obligation to fulfill. And in our experience as BDO, it's been best, and our best advice is to adopt a system and a process that you can use for maintaining records of the trust. You know, in years gone by, the minute book was this system and the process, the good old manual minute book. Thankfully now technology has replaced the minute book with some really amazing systems that are easy to use and that really bring efficiency and allow you to capture, record, sign, and store everything digitally. And again, in a digital sort of storage system, ecosystem, where everyone can access. I know for ourselves at BDO, we've recently adopted the BDO Trust Portal, which is a proprietary cloud-based platform that allows trustees to have a single view of the trust file from anywhere in the world. And it's something which has proven to be really useful during the pandemic that we're living through. And so gone are the days of every trustee having their own trust file. We've now got one single version of the truth. So just a couple of points before I ask Fia to share some practical experience on recording. Just to highlight, resolutions is really the heart of trust administration. I said it earlier, a trust is run by resolution. There's no votes, there's no majority vote in a trust. All trustees need to agree to the resolution before the trust can act. I think be careful and understand your trustee or the trustee in terms of the type of resolutions permissible. There are resolutions that are drafted at trustees meetings, and there are also round-robin resolutions, which is essentially signed by one trustee and emailed to the next or courier to the next. Does your trustee or the trustee allow for either of those? Just check the deed before you commit to a resolution. Again, just on the asset register, when it comes to recording, this is in this step of the cycle, it's an ongoing requirement to maintain the asset register. It's an essential exercise to make sure that the assets are up to date. Financial statements, we know, disclose assets, and there's a note to the financial statements, but that's not an asset register. Like I've said earlier, the onus is on the trustees to identify and separately identify the trust assets. I think an important point, because the trust is an accumulation of assets, this asset register is really the core of that administration requirement in terms of the Trust Property Control Act. And by identifying trust property, what it helps with in this recording process is preventing or exposing trust assets to the risk of a trustee being sequestrated or liquidated and having that asset attached as a trustee's own asset. So that our recording in the asset register and our clear identification is critical to separate ownership of assets. A note on bank accounts, we've mentioned it earlier, but a trust needs to have a bank account. But one of the most common pitfalls we see in practice is that trustees run the trust's cash flows, the trust income and trust expenses, through a third-party bank account and not through the trust's bank account. We often see business accounts or trustees' personal bank accounts being used for trust expenses and income. And believe it or not, we've often even seen trustees using their credit cards to pay for trust expenses. And unfortunately, this blurring of control of trust assets is fraught with risk. If it's a trust asset, that transaction must flow through the trust bank account. No other way. All income earned by the trust asset must be deposited into the trust bank account, and all expenditure incurred by the trust must be paid directly from the trust bank account. It does happen often, and in some instances, that a trustee would incur an expense on behalf of a trust, and that's okay. What you need to do, though, is document and record. Is that a loan that you've made as a trustee to the trust, or is it a donation? If you don't record it as a loan, the default position by SARS will be a donation. So best to record it as to what it is. And lastly, in terms of our best practice when it comes to record step in the administration cycle, is have a filing system. I said it earlier, we call it the single version of the truth. It's very common that most trustees and trusts have several files. When we engage with trusts for the first time and taking on trust administration and acting as trust officer, we often present it with pieces of a puzzle that we have to put together. And that need for a single file and storage system is critical to be able to effectively account to the master and account for your duty as a trustee. And again, using technology, there's some really smart systems available to have this central repository of documents. And it's something that we've adopted at BDO with our trust portal. Sophia, again, recording is a crux of administration, but maybe pinpoint one or two cases that really talk to the practical experiences that you can share on record.
Ricardo, I see we're running out of time, and I have one really juicy story which probably summarizes the last two pillars. I would like to reserve my juicy story for after you're done with the last one. I think I can summarize this pillar of recording and documentation as discipline. It is only discipline that people have to apply. Make sure for every transaction you have a resolution. The court said a trust is run by resolution, not by a decision. So again, we're back to our old story as to how do we participate, how many participate. At the end of the day, outside parties rely on a piece of paper, which we call a resolution. In other words, does the Board of Trustees support this transaction, yes or no? And unless we have that recorded and retained for future reference, you are going to pick up issues. Again, I can refer you back to the FNB case, which was one of the issues where the courts weren't too nice with the Brits family. So you can have a look there. So the resolutions is absolutely the crux. Something that a lot of even conveyancers are getting wrong is to still allow the acquisition of property before a trustee is authorized to act or before a trust is registered. It is very important to remember that you need prior authorization in terms of the Land Alienation Act. We need to make sure that we have prior authorization because the trustees are regarded as an agent. You have to have that prior authorization, and the courts confirmed that in the Thorpe case of 2007. So maybe that's just the only practical one I've mentioned here, and then I'll save my juicy story for last, Ricardo.
Thank you, Fia. So let's move to the last step in the cycle of administration, and that's statements and the reporting. Trustees are accountable to report to each other, to the master, to beneficiaries, and to SARS. That's it, and that ends that cycle of administration. And statements is all about the need, or the step, or the cycle in the cycle of admin is all about the need to have relevant information. And this goes beyond the basic balance sheet and income statement. I think what is often misunderstood is that a trust asset needs to have separate information. You actually need to silo trust assets and record them as such. So the assets and the trust asset specific related income and expenditure needs to be separated from other assets, income and expenditure. And so in terms of reporting and recording and having statements available, you can't subsidize one trust asset's expenses with another trust asset's income. The reporting is critical. Otherwise, your ability to apply attribution rules will fall flat. And your ability to report to beneficiaries and the master will also fall flat. What we've seen in practice is that not all accounting packages have this capability, and often the accounting packages really reflect and record collective balances and expenses. And unfortunately, with the focus on trust by SARS, this area of statements is often an area that trips up trustees. And so accurate reporting is needed, and that will justify how trusts have been managed. And like we said, these reports need to be available for inspection. Another point I think just to consider is the fact that asset register really backs up financial information. And so that asset register again comes up and under the statements phase of administration. And a last point in terms of the statements phase of administration is tax compliance. And it all starts with the trust being registered for tax and then submitting both provisional and annual tax returns. And to do so, you would need financial information. And that's really where the balance sheet and income statement comes into its own, is providing those transactions that you can then use to report the tax position for the trust. A critical focus of SARS of late is the connected person reporting. And that extends to not only reporting connected parties, but also the reporting the transactions between these related parties. So, Fia, over to you. Share with us some of your juicy stories around statements.
Yes. So just some practical points on statements. As you said, Ricardo, we need a reporting format to stakeholders in the trust. Who are the stakeholders? Obviously, your beneficiaries. They need to understand, in terms of beneficiary statement, how much was distributed to them for inclusion in their tax returns. They need to understand any balances owing to or from them. So that is one major stakeholder that we have to do tailored reporting to. And then obviously also for SARS, typically, because they are scratching now in terms of loan balances, how are they made up, which assets are they funding. So it is very important to understand and remember who the stakeholders are using trust statements specifically, very different to company statements. So that's the one point. And then once you've got those statements, believe me, there are still people, we're getting letters every day to say we do not have a duty to report to a beneficiary. Trustees do not have a duty to report to beneficiary. I cannot understand that, because there are multitudes of court cases where the courts have been saying beneficiaries have a right to know. Beneficiaries are the main stakeholders in the trust. You need to be transparent with beneficiaries. So the Doyle case, I use that frequently. And it's a very practical case. I mean, the mother was the income beneficiary of the trust, and then the son only became the capital beneficiary upon the death of the mother. And obviously then he asked the trustees to actually provide him with information, because he wasn't a beneficiary before. And then they said, no, your mother was entitled to it while she was a beneficiary. You only became a beneficiary now, so you can get information from now on. And the courts turned around and said, absolutely not. Even if you are a discretionary beneficiary, you can go right back to the inception of the trust. And the level of detail that people can ask for beneficiaries is right down to voucher level. Now the check stubs and those for all the ones of us. So that is the level that you can go to in terms of information. So a couple of very nice points to remember around reporting to beneficiaries, that you are entitled to information, and that trustees have an obligation. What are you hiding by not providing information to your main stakeholder? So my juicy story is talking about recording and statements, and I'll try and keep it really short because we're running close to finishing. Is this daughter, typical family trust? The grandmother set up the trust. The family's been living on this property for generations. The grandmother, who owned the property in her will, bequeathed it to a trust. And then because her son was, people were advised, you can't be trustee founder beneficiary, becoming too close, so rather make the granddaughter the beneficiary, and she's the only child, so she was the only beneficiary. So the father was never a beneficiary. He was obviously a trustee because he took over from mom, and he was running the property as a hotel business for his life. And typically, like people do, it's his property. They always lived there. He grew up there. And the accountant many years ago, who was his neighbor, was appointed as accountant when the trust was set up. And then they had a fight in the area because some people wanted to develop the land for industrial purposes, and others said, it's a green area. We need to protect the environment. So those two groups many years ago became kind of rivals, and the accountant completely lost contact with his friend at the time, his neighbor. And many years later, when the daughter got fed up when the father got a new friend in his life, the daughter got upset because she said she's the only beneficiary, she needs to benefit from it. The father wanted to sell the property because he got a really good offer for it, and then that's where it hit the fan. And she took that to court, And then the court said, where's the accountant? So he called his old friend and said, we have a bit of issue here. We take him to court. The friend was the accountant and the trustee, problematic. Then just to help his friend, they said, right, cigarette box style, let's quickly do calculations. What happened? No record keeping, nothing, because, you know, it was just a place where they lived, they ran a business from. So cigarette box style, they drafted financial statements, presented that to court, very happy. And then the courts turned around and blasted them, and it actually got so bad. And the court said, you just reproduced you just produced these in kind of retrospects, and slammed the fact that there was no meetings, there was no minutes, there was no resolutions, and basically removed both of them as trustees. And here comes the bit. They were held liable, joint and severally, for 700,000 Rand legal cost. So coming back to my issue, the fiduciary role that you act in, the personal liability that you pick up by being a trustee, the consequences of being an accountant who just, you know, does a favor to your client and you know, do things that you know wasn't done properly at the correct time, may get you in really, really big trouble. Such as this accountant, he retired now, he was going to move down to Durban and basically had to, you know, because the father doesn't have a cent, so he has to fork up 700,000 Rand now for his ex-friend, and it's for something that he never ever had a benefit from, and thought he was doing his friend a favor by doing a cigarette box style financial statements for the last 20 years. So I think that demonstrates, you know, the whole record keeping documents and statements, if you do it kind of slapdash, what the courts can do to you.
Thank you, Fia. I think that really, I think, summarizes the need for SARS. I never thought that we'd have SARS as our friend, but really this framework of setup, act, record, and statements is a cycle, and it's an essential framework that you need to follow as a trustee and then repeat. So it is repetitive. So once you've got statements, it's not done. You then go back to setup, and in setup is reflect on the trust deed. Is the deed still relevant? If not, review it. I think we often come across trust deeds that are older than 2001. And if you've got a trustee that's older than 2001, definitely the deed needs to be updated, at least for CGT, regardless of other family circumstances and changes. And so the setup, act, record is a continual cycle of administration that we would recommend trustees to adopt. Having a system will ease the burden of administration, and that's our best advice. Is you can use manual filing systems. They work, they are cumbersome, and so I think with technology that abounds, is consider digital cloud-based files. It really will simplify your administration. And we know that trust administration is complicated and can be overwhelming. And so if you are concerned, or you'd like to do a self-assessment of the administration of the family trust or the trust that you're a trustee to, we do have a BDO checklist that can guide you to identify areas of risk or potential non-compliance. And so we'll post in the Q&A chat a link to the self-assessment form. It's a free to complete. It's a checklist of about 28 questions. It really covers all aspects of trust administration that Fia and I have dealt with this morning in the talk. And so Fia, in wrapping up and closing, what happens when trust administration fails?
Ricardo, it may fail from the start when a trust is a sham trust and it actually is declared not to exist, which means that, you know, you can do nothing, you know, going forward. The trust does not exist. It actually starts there. When we have a beautifully crafted trust deed, and we disregard the powers, we disregard the obligation, we disregard the trust deed, we disregard the separate form of the trust, and through our behavior, we treat the assets as our own, then you may end up still undoing your whole estate plan. And then the courts obviously label that as an alter ego trust. And I think the goal is, when you set up a trust, be serious enough, understand what you have to do, and actually execute it. So, you know, especially when we look at alter ego trust, you know, most people who attack it are people going through divorces. So you can see the courts have been all over the show. So if I could just make, you know, in closing, a last couple of statements is, be careful the courts, because they, they change their minds, they take different angles. There was a case in 2015, WT versus KT, where the court said because the wife is not a beneficiary and not a transacting entity with the trust, she's got no standing to question the trust, even though she was going through a divorce. So the advice there is, when you set up the trust, the first pillar, make sure you are at least a trustee and hopefully a beneficiary, because you can't benefit otherwise. So that's what the court said. And then in 2017, in a Mills case, also not a great judgment, the court said, even though your behavior may be questionable and you're sloppy, you must prove that there's an ulterior motive. So again, becoming really difficult and really murky to actually motivate and justify. And the court said, if a trustee is sloppy, rather just remove him, so they're not going to pierce the corporate veil. However, in 2017, the court started getting fed up, and there's a REM case in 2017 where they clearly distinguished between a sham trust and an alter ego trust. And they said, you know what, if it's done to actually do somebody in who actually married and was entitled to accrual, that is what the courts are going to do. They're going to pierce that corporate veil. And then in 2020, there was an IK versus MK case where everything was going very well until the wife had an affair. Then the husband set up a trust, and when he set up the trust, he drafted in such a way that he could do whatever he wants. He could decide who the beneficiaries are. He can decide the manner in which the assets are to be dealt with. He actually mingled his personal assets, so there was no separate treatment of the trust. Journal entries were passed, so you can see this was just kind of a smokescreen. This wasn't really, to actually have a separate trust. And the court said, they're not going to allow that. So if the purpose of a trust, which is obviously what this guy did, kind of planning for divorce, if the purpose is to conceal assets through fraud, dishonesty, or with the improper purpose to avoid your obligation, in terms of the accrual, then the courts are going to pierce that. So I think the message out there, although the courts, sometimes make very interesting, judgments, the judges, I think, the message coming through is the courts are going to pierce, and more and more trusts are going to be declared alter ego because we haven't got the paperwork in order, as Ricardo said.
Thank you. And so let's wrap it up with on that point. Thank you, Fia. I think what we've demonstrated today and hopefully shared with you is that the execution of administration is key to the success for a trust. And financial statements are not administration. So regardless of the advice you've taken, whatever your intentions were for the trust, that legacy of love that you intend to leave through establishing a trust will fall apart if there's not effective trust administration. We've had valuable insight on this series from Alan Hainan on the financial planning for trusts. Trevor Dickinson positioned how family governance marries with a family trust. And Fia has really shed light and explained the importance of reviewing the trust deed and ensuring that it aligns to both the financial planning and objectives and the financial and the family governance structures for the family business. And all these elements are all sound and good practical advice. But without effective administration of the trust, this advice will fall flat and on that execution. And so in leaving a legacy for beneficiaries, we urge you to consider the importance of educating beneficiaries. That it is actually extremely important that the beneficiaries get involved and understand the administration of the trust and that it's being done effectively. It's also very important to consider the next generation of trustees. How do you pass on the baton? How do you bring both beneficiaries and the next generation of trustees into the conversation and train them so that they can be effective custodians of wealth for the family? And with that, understand that there will be generational differences in those conversations, but embrace it. And I think ultimately our closing message is that have a system of administration, and if you're not able to do it or don't want to do it, bring on a professional trust officer, someone that will stand by your side and prompt you to take action and show you what to do, when to do it, and how to do it, and easing that burden of administration. But whatever you do, please avoid the trap of thinking that trust accounting is trust administration. Thank you for your attendance. We're gonna. I know we've run over our time, allocated time, but I would like to take a couple of questions that we've received, and so we'll move into a Q&A session. We'll deal with a couple of the questions, and those that we don't get to deal with, we will reply to everyone that attended the webinar with a detailed Q&A of those questions that we haven't answered. And so, yeah, if I may just pass my attention here to the Q&A, and I'm going to loop you in here on some of these questions. We've had some really good questions coming through. I think the one that I'd like to start with is, give me a minute. There we go. So with regards to control, if I am bringing my wealth into the founding of a trust, then surely I have overriding authority over the management of these funds, or should this be annotated in the trust deed? I think a great question to start our conversation, Fia. Over to you.
I think that's where us South Africans are battling, particularly, is to relinquish that control. So the fundamental principle of a trust is you have to relinquish control, and you have to separate the control and ownership from enjoyment. And I know it's very hard to do because basically a board of trustees have to decide over the assets going forward. Therefore, it's so important to make sure you have the appropriate board of trustees around you. You are definitely allowed to be a founder, a beneficiary, and a trustee. The Goodwood case confirmed that. So you don't have to take advice where you're not in one of those boxes and end up with that divorce case where the wife was nothing. However, I am saying, yes, it may be you're the founder of the trust and you're the estate planner or the previous estate owner. So we can build some protection measures in the trust. However, one needs to be very cautious. Sometimes people cross that line where it is sufficient influence versus controlling the trust. Controlling the trust, overriding other beneficiaries, whether through behavior or through what the trust deed allows, one must be very cautious about. So I think the most important thing is you have to structure the trust deed and stay clear from clauses where you retain control. Secondly, you need to appoint the correct trustees who understand the purpose and the objective of the trust, and to do that for generation after generation. And then thirdly is the way you behave. You have to demonstrate that you include everybody, right down to paperwork.
Thank you, Fia. I think that is the crux of trust ownership of assets, is that separation of ownership. And there is a fine line in terms of actually controlling the asset versus actually taking advantage of the trust structure and the benefits of it. A comment that was made here, which I think I just want to pause on, is that we spoke about the letters of authority, Fia, and the fact that your authority is not confirmed until recorded by the master. The comment here was that the master takes so long to register and deregister trustees. Is there a way to get around that? And the comment is, this is a huge blow to compliance.
Yeah, I think when you register a new trust, it's particularly problematic. So in my book, I have discussed the whole notion of an oral trust, which is an option if you have to acquire a property. You just have to convince, your transacting party that you have an oral trust. That's one option. Another option that the legal fraternity proposed is a stipulatio alteri, that is a contract for the benefit of a third person, and then to just kind of ratify it once you register the trust. So that's a little bit complicated, just to get around the practical issue. So yeah, I think to register a trust, you really need to move quickly. As soon as you know you want, get the trust registered, and then you can do all the transactions and purchase the property, whatever you want to do in there. With appointing new trustees, unfortunately, you cannot act unless you are on the letter of authority. And remember, the court said that serves two purposes. Obviously, it's for the benefit of the beneficiaries, and then also for the outside world, to make sure that they don't enter into a transaction with unauthorized trustees. So I can understand why you cannot act without that letter of authority. So it's not with immediate effect, I'm acting as a trustee. And the courts and the master is meeting us halfway because of these inefficiencies. When we resign as a trustee, they will go to the point where they say, right, as long as you have submitted your resignation and the master, you've got the master stamp that they confirm a receipt of that resignation, you can still get away with, that evidence for a trustee not signing. But the starting point is only letters of authority trustees can act. But because of the inefficiencies, the courts and the master are meeting us halfway with the resigning trustees. But unfortunately, with acting trustees, only when you physically authorized, and it doesn't make sense.
Okay, thank you, Fia. We're going to take 2 more questions and we'll close. There's a comment and a question by PSN and Oscar, which are quite similar. So I'll merge them together, if I may, and if you can just reflect on this. And the essence of the question is around what action can a beneficiary take in enforcing trustees to make full trust accounting or documents available after numerous requests to trustees. And that goes on to a PSN who adds to that comment to say that he's been denied access to the files for 6 years. So can he request the master to force the 2 trustees to file all documents with a business, an independent trust administrator like BDO? So what's the situation with that, Fia?
Yes, we're happy to assist. I'll try and answer very shortly. You can use the Doyle case. I mean, it's legal precedent, so trustees have got no choice. But some, are so hard-headed, they still believe they don't have to give you anything, and what are you going to do about it? People don't have money to run to court. We know how long you queue outside the courts to get your chance. So first of all, you have to put in writing that you requested in terms of the Doyle case. Give the trustees a deadline. If they do not act in a certain period of time, you can approach the master and ask the master for assistance to compel the trustees to account. And then if they don't, the master has got a power to remove them as trustees. Alternatively, you can go to court.
Okay, perfect. And that is something that it would be best to call on professional help to take you through the process.
Sure.
Thank you. And let's close with a question from Richard King. It's around resolutions. I think Richard's comment is that he acknowledges that trusts are run by resolution, but he's just questioning the round robin resolution. Does it really specifically need to be allowed in the trust deed? Or is it just a default position that you can either have a round robin resolution or a meeting resolution? What's the legal position here?
Yeah, I would say if the trust deed is silent about and say there would be meetings, I think you need to go back to the wording of the trust deed. So if it's vague and somehow it makes provision for electronic, one can have a look at that. If the trust deed obviously specifically prohibits it, then you can't do it. So I think your starting point is your trust deed and see whether it allows it or potentially disallowed.
Okay, excellent. Yeah, thank you, Fia. And we do have a number of questions we don't have time to get through. And so I think in the interest of time, let us close now. We will address and circulate a Q&A to all attendees on the call today on those questions. And so I'd like to thank you, Fia, for your participation and your input. It's extremely valuable having your perspectives and your insights. And I think what we take from the series, and particularly just closing on trust administration, is not to procrastinate. I think take action, get advice, but tackle it. Don't ignore it. I think having someone that helps you, whether it's a trust officer or another professional that can guide you and look out for your best interests, is a great insurance policy to make sure that your trust remains valid and meets the purpose for which it was established. So thank you for joining today's conversation, and thank you for joining the series. This webinar was recorded, and a link to the recording will be made available on the BDO Wealth website, as well as the BDO YouTube channel. If you have any questions or need any assistance relating to the administration of trusts, please do reach out to us, and we'd be glad to explore how we can help you. Stay well, stay safe, till we connect again. Goodbye.